Let's welcome in our market master of the day. Pankaj Tibrewal is founder and chief investment officer at IKIGAI Asset Managers. Pankaj, welcome back. It's been a while. Thank you very much. You've been ahead. You turned cautious early, and do I dare say you're turning a little more constructive early? Explain to us the thought process, how it's changed, and where are we now?
Good morning, Prashant. I think to crystal gaze 2025 and the markets ahead, we have to see what worked in our favor last year. So clearly, one thing which was clearly in our favor was commodity prices. They have been benign for a while, and that helped corporate India on margins. And we saw record margins in most of the sectors for corporate India. Second, I think the one-time dividend which RBI gave to the government helped on the government financing. The third thing is the capital gains and the STT, which in our view this year will be 2.5 lakh crores, 1/4 of the personal income tax collection, and that probably helped on the government financing. And fourth is the bond inclusion inflow, which we saw to the tune of $17-18 billion. And that offset the kind of weakness we saw on the foreign FI flows on the equity side. And obviously the last one was the strong domestic flows. And hence we saw a market where broader market did well than the frontline indices. Going into 25, some of the concerns which I think are genuine and we need to address them. One, we did a dealer check across the board, across distribution, across sectors. And one thing which is coming out clearly is that the liquidity is extremely tight. And that's also shown that after 5 years, the liquidity in the banking system has turned negative. And we believe that sooner or later, RBI should resume OMO or forex swap transactions to normalize the liquidity into the system. But across businesses, across distribution, the common language is the liquidity is tight. And working capital cycle has got elongated across the board. The second one is that probably the government Capex has slowed down materially. Though we expected that in November, December, post-monsoon, it should pick up, but we have seen only in some in some sectors, government Capex picking up. But broadly speaking, I think government Capex is down. And our sense is this year, compared to the budgeted number, will be down by about 10 to 12%. And hence, we should undershoot on fiscal. From 4.9, we should end up at 4.7. That's our expectation. Once government comes back, I think government Capex comes back, I think we should see normalcy coming back. The third thing is a lot of froth is out of the system. The index masks the damage. Though the index is down about 12 to 14%, depending on which indices you're talking about. But when we look at the entire universe of 4,600 stocks, about 75% of the universe is down by more than 25% plus. So clearly there has been a lot of froth which has been taken out of the system, and growth has slowed down, and so has been earnings. Our belief is that after the third quarter results, the FY26 estimates, which in our view is still on the higher side, should get reduced to between 10 to 12% or 11 to 13%, somewhere in that ballpark. And once that reduction happens, we believe that constructiveness should be there on the market side. However, I would like to caution that money making, the way we have seen in the last 3-4 years, the easy money is behind us. We should now work on bottom-up ideas and make sure that stock-specific movements will happen. Also, various sectors, 3-4 sectors which are there, which probably is a contra call. One, I think cement, clearly. It's back to 2003-4 in terms of contribution to profitability. The second is metals. Nobody is talking about it. But if both the economies, the largest ones, China and US, goes on fiscal expansion, I think liquidity will be abundant in the global system, and that should bode well for commodities. And third is specialty chemicals. After 7 quarters of decline in specialty chemical on an aggregate basis, this will be the first quarter where we see marginal profit increase on an aggregate basis. That's our assumption. And probably for the next 4 quarters, specialty chemical is one segment which should show strong earnings growth, partly because of a lower base and partly because of destocking in agri coming to an end. So that's where we are. But I think the easy money is behind us. Markets should consolidate for next 12 to 18 months, and bottom-up ideas will make you money.
Well, just want to say that the consolidation is well and truly on even today, and this is a morning that we need to take note of. India is a rank underperformer across Asia. Asian markets are cheering. They're up anywhere between 0.5% to 2.5%. But look at us, the Nifty is struggling to hold on to this little shade of green. And the Bank Nifty gain that you're seeing, about 0.5%, that's largely driven by Kotak Mahindra Bank and State Bank of India. SBI is keeping its head above water because otherwise there's a lot of profit taking underway in BFSI. I just want to highlight that because that's the key trend of this Monday morning, profit taking in BFSI. Shriram Finance is still down about 5%. SBI Life is now down 2.5%. IndusInd Bank, HDFC Life, look at HDFC Bank, look at ICICI Bank. Basically across the board profit taking on BFSI, barring one or two names. Pankaj, hi, morning. So I want to actually, dive a little deeper in this pocket because I think this is the next piece of the puzzle which the market is trying to wrap its head around. Now, you've got Kotak Mahindra Bank on one side. Wherever, governance and management qualities of high order, I mean, look at what they've done. They've expanded margins. Their slippages have fallen. And the market's saluting that. On the other hand, you have an RBL bank and you have other lenders where the asset quality pain is beginning to show up. How will you navigate BFSI? And on insurance as well, the market doesn't seem to be very convinced. We had a couple of good days of rally after the HDFC Life numbers. But look at this, it's already profit taking this morning. So clearly, there is nervousness in pockets like insurance. How will you pick and choose in BFSI?
Good morning, Surabhi. So if you look at BFSI, two things are very important to note. One, I think last cycle in BFSI was all about corporate loans. We believe this cycle will be all about retail. And we were doing some number crunching. In FY20, the total EMI burden of India on the consumer side, which includes housing loans, consumer loans, credit card loans, vehicle loans, microfinance loans, was to the tune of 19.5 lakh crores. That's the total EMI burden. In the 4-year period, that has moved to about 40 lakh crores, almost doubled. So households have leveraged, and as a percentage of GDP, our belief is the leverage is now at 43%, which used to be 32-33% few years back. And the incomes have not gone to the same extent. And I think that's creating pressure on the retail asset quality side. And whichever companies have grown in this space at a very fast pace, especially on the unsecured side, will have to face the brunt. So we need to be extremely careful on the BFSI side that what is the loan book? Is it more unsecured? Then we need to be a little careful on that. And I think that's something which is a reality. That EMI burden has increased almost 2x in the last 5 years, compared not to the income levels moving to the same pace. And the second is that most of the assumptions, if you look on the BFSI space for banking and BFC, the loan growth is anywhere between 14 to 15%, assumptions by the street. The credit growth has come down to 11%. That means that some more earnings downgrade will happen in this sector before the sector sees the bottoming out. On valuations, it looks to be decent, but on earnings assumptions, I think it's still on the higher side. If the credit growth remains at 11-12%, post the third and the fourth quarter numbers, we may have on an aggregate basis reduce the earnings estimate for next year for BFSI, banking and NBFC especially. On the other hand, if you look at the insurance space, especially the life insurance guys, they seem to be very well poised. If we assume that the yield curve will steepen going forward, they are the best proxies in this environment. So from our perspective, we need to be a little choosy on the BFSI space. Few names on NBFC and banks, which are better on the secured loan book. Few names on the life and general, I think should make a good portfolio on the BFSI side, at least for the next 12 to 18 months before we take a relook on our call.
All right, got that. Pankaj, a little shorter chat today because of all the earnings and lots of the management interviews that are lined up. So we'll keep it brief. But thank you very much. This is helpful. And we look forward to a longer, more deeper chat next time we catch up. Thank you very much. Have a great day.